It's Friday the 21st of August, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and this is a special episode all about what on earth is happening in bond markets. We've been inundated with client questions about why long-dated bonds have been selling off, and not just US Treasuries, about whether we're seeing another global crisis, about what governments can do about it, and of course, more immediately, about US Treasury Secretary Scott Bessent's latest market intervention. We addressed all of these questions and more in a drop-in, which is one of our short-form online briefings on Thursday, and to timestamp that, it was held at 10 a.m. New York, 3 o'clock London, and we thought this week it was worth sharing an edited extract of that session. In this extract, you're going to hear Neil Shearing, our group chief economist, and chief markets economist Jonas Goltermann. We hold regular online briefings like these each week on global macro and market developments. If you're not already a subscriber to our services, you can start a free trial now from our website, capitaleconomics.com. Anyway, here's that extract now. It starts with Jonas updating us on the latest moves in bond yields.
We had a bit of a reprieve over the past couple of days, but it looks like the long end yields are showing that off and rising again towards, although not quite all the way to the levels that we saw at the end of last week, which of course, it's a striking thing. In the US, we've seen 30-year yields at the highest level since 2007. It's similar in the UK and Japan. I guess in Japan, it's even longer than 2007. And the Eurozone long end yields highest since early 2011, so before the Eurozone crisis really kicked off. So it's symbolic more than anything. The pace of this increase, it's pretty rapid, but it's not exceptionally rapid. We're still well short of crisis territory, like we saw in, say, the autumn of 2022 or 2023, or the kind of sell-offs that we saw earlier this year in March when the US-Iran war started, or last April after Liberation Day. So overall, it's worrying, but it's not panic stations quite yet.
I do want to drill down into what caused that reprieve, however temporarily, but I just want to pull the camera back a bit because I want to make the point this is very much a global story, isn't it, Neil? To what extent, though, is what we're seeing in advanced economy bond markets global, and to what extent are there idiosyncratic factors at work here?
As ever with these things, it's a bit of both, I'm afraid, at the risk of giving you an economist answer. Although the headlines have focused, for understandable reasons, on Japan and the US, actually, this sell-off has been pretty global in nature. Japan's a little different. I'll get to Japan. But if you look at what's been happening in the US market, if you look at what's been happening in UK gilt market, in French government bond market, Italian government bond market, we've seen yields rise kind of across the curve, but particularly at the back end of the curve in those countries. Japan's a bit different because we're seeing yields rise across the curve, and we can get into the reasons why that might be the case. And so that leaves only relatively a small number of countries that are the government bond markets that have not been so much affected by this sell-off. And typically, and this gives you a hint of what might be driving the sell-off, they're the ones where governments have stronger balance sheets. So Canada, Sweden, Switzerland, the yields have barely budged. Clearly, they're safe havens as such in this sell-off, not very deep and liquid markets either. So it's not just the US, it's not just Japan, slightly idiosyncratic things happening in different countries, but it's pretty global in nature, the sell-off.
Someone's asked, they made the point about higher interest expenses, worsening demographic pictures, increased demands for defense spending, higher defense spending, and then on sort of on the demand side, perhaps some sort of structural weakening there that we can get into. But their fundamental question is, are we seeing the sustainability of debt in these economies being fundamentally tested?
Yeah, I think we are, frankly. And this is something that we've been warning about for a while. Now, I don't want that to suggest by that we're heading for some kind of an imminent fiscal crisis or bond market crisis. And that's not what I'm saying. But we were warning as far back as 2 years ago the fiscal risk were building in quite a substantial way across developed markets, that economies were now back at full employment after the pandemic, and yet budget deficits were still extremely large, debt burdens large. And of course, the big shift that's happened over the past 2 or 3 years is that we've gone from a world in which, certainly post-GFC, through to the pandemic, real interest rates were negative, and now they're not so negative, and in many cases positive. So you've got these confluence of factors. Economies returning to full employment, deficits still large, real interest rates no longer negative. Then you overlay on top of that a series of stagflationary shocks on the supply side of economies. That's a pretty toxic mix for bond markets. I don't think we're necessarily in fiscal crisis territory yet, but it does, I think, to my mind at least, underscore the unsustainability of the kind of fiscal trajectories in a number of countries.
Which economies, this is another question that lots of people have been asking, which economies do we see the greatest risk of a fiscal crisis?
Well, I think the first point to say here is a really good question, and it's one that we get all the time. But I think the first point to say is that there's no kind of magic number or magic threshold for what constitutes fiscal sustainability. It means different things in different economies. If you look through the broad sweep of time, you've had sovereign debt crises, albeit in emerging economies, when government debt to GDP has been as little as 15% of GDP, but that's because of the characteristics of that debt, lots of foreign currency debt in the system, and then the currency peg breaks and you get a fiscal crisis. At the other end of the spectrum, we've had Japan, where the gross government debt burden has been in excess of 200% of GDP, net government debt well above 100% of GDP for decades, and yet nothing has broken. So there's no magic number. I think it's wrong to say that you go past this threshold, there's a crisis. Instead, it's the perception of sustainability that matters. And that's what I think makes this sell-off so dangerous, that the bond market seems to be sniffing that something's not quite sustainable, that we're on the wrong footing here. And then things can unravel and get away from governments pretty quickly. To answer your question, though, as to which countries are most vulnerable, there's 4 that stand out to my mind in developed economies. They are not Japan, actually, despite the high debt burden there, very high domestic savings rate, quite difficult to see a fiscal crisis emerging in that country against such a backdrop of a high savings rate. In fact, the numbers are improving there. Instead, it's the US, it's France, it's Italy, and it's the UK. If you're thinking about triggers, well, beyond this kind of wobble in the bond market, then you might have got a reprieve from Secretary Bessent. The bond market may have got a reprieve from Secretary Bessent over the past 24 hours, but we've got elections coming up in both France and Italy next year. I think they could be kind of another trigger points for stress in the bond markets if they go the wrong way.
I do want to get on to the intervention by the US Treasury, Jonas, but before I do, can you just get on to the sort of the mechanics of the rise in yields? With all that Neil's just said there, the move up that we've seen at the long end in yields, lots of people ask if you could break that down for us. What exactly has been driving up yields?
Well, it's a good question. And it's one of those where there isn't really an obvious trigger in terms of events or news that would have, has led to this move over the past few weeks. I mean, the news out of the Middle East has been a bit worse. Energy prices have crept up a bit, but it certainly doesn't explain all of this. And you've had, but there hasn't really been political news in the US or Europe. Most Europeans are on holiday anyway. So a number of bond investors, which maybe is part of why this is happening. So that doesn't help either. There's been some noise out of Japan, but it's hard to know what to make of that. And as Neil mentioned, the move there is actually a bit different in character than what we've seen in US and Europe. So it's hard to sort of put your finger on, well, this is what's wrong. If you had to pick one thing, it is probably the post-FOMC press conference that the new chair, Kevin Warsh, gave 3 weeks ago now, which was not well received, certainly by the long end of the Treasury market, which I think sort of revived this sort of concern that the US, the current set of US policymakers are going in a different direction and introducing new ways of doing things, which the bond market doesn't necessarily love. Markets tend to prefer stability and certainty over change, even if that change isn't necessarily ill-conceived. It's just, in this case, not fully communicated at this point. And I think Bessent's intervention, kind of along with the currency intervention that they did a couple of weeks ago, it all adds to the sense of, well, I'm not sure what you're trying to do here, but clearly you're worried about the long end of the bond market. And since you're in charge of all this, you must know more than I do. And if you're worried, I mean, I was already worried, but now I'm more worried. And the fact is, as Neil was saying, you take a step back, it may be surprising in some sense that this move has happened without a clear trigger, but the backdrop is fiscal deficits are unsustainably high, certainly in the US, but elsewhere as well. debt levels are very high, and the bond market, is sort of the seams are tearing a bit. So in that sense, it's not surprising at all that yields are this high.
I think to build on that and to add to that point, we get a lot of questions about the extent to which the large net issuance from the hyperscalers and other tech companies has added to kind of debt stress and debt concerns. And clearly at the margin, I think that has been the case. But it still feels to me that that's a relatively small part of the story. I mean, you might have a different take, Jonas, but if you just look at the sheer numbers involved, net issuance by the US Treasury this year is going to be something like, or at least double, but probably 3 times the size of non-financial corporate debt issuance. And if you look at this, the outstanding stock of debt, many, many times higher. So you've got 24 trillion of outstanding long-dated Treasury debt versus about 8 trillion of non-financial corporate debt in the US. So I think it's one of those situations where you get a kind of big move in markets and everyone reaches for a kind of explanation. Everything gets kind of thrown in there. But I think at root, this is a fiscal problem and a manifestation of fiscal strains that has not been helped by large net issuance by some of the hyperscalers and tech companies. But I think that's the cause.
Yeah, I mean, a couple of points to add to that. I mean, the issuance by these companies is pretty striking, and it's up from basically they used to be not issue much debt at all, and the hyperscalers, just those 5 companies, has issued about $200 billion worth of corporate debt the past year or so. And it's in some senses more than that because they used to be net savers. They used to, all that cash, all the profits they were making would converted into cash savings for the most part. They paid some dividends, but not much. And so in some sense, they were actually helping to fund the US Treasury. So that sort of net swing is over the past 2-3 years is quite dramatic as they've pushed this AI infrastructure build out. And I guess the other point about that is that, well, if you think about why are interest rates higher, well, it makes sense. You have an investment boom ongoing that's pushing growth higher. All else equals, that pushes up on interest rates, both at the short end and at the long end. And in some sense, that is a positive development, or at least in principle, it could be a positive development, which is one of the points that Mr. Walsh has stressed. And if it leads to sustainably higher growth rates in the economy, in that sense, higher interest rates would be, not a bad thing. It would just be a reflection of a positive development.
So your questions come in. We had a question earlier this week. It wasn't really a question, more a comment that, you look at yields now in a pre-2008 world, that's kind of just looked normal, right? So what we're seeing to some degree is a return to normality. And Neil, I know you referenced earlier what was going on in Japan. What would you say to people saying 5% yield, we're just going back to where we were, this is what the world should be?
Yeah, I think there's something to that. Right? I think there's something to the idea that we shouldn't lose sight of the fact that we have spent the last probably 10 or 15 years talking about the unusually low interest rates, how distortive they are, how that leads to misallocation of capital, and how we need to get back to more normal, quote unquote, levels of rates and yields. And now we've got back there, and the markets are freaking out. So I think there's an irony there. We shouldn't lose sight of the fact that, to the extent this reflects the fact that disinflation and deflation is no longer the biggest danger. The economies are back at full employment. That's a good thing. But the backdrop is critically different from where we were mid-2000s, last time we had yields at this level, with regards to debt burdens. Like, gets back to the point I was making before, that we're at full employment, we've got large deficits, the debt burden is large, and now we've got real interest rates that are no longer negative. Now, all of that was being sustained. Those debt burdens will help to be sustained by the fact that real interest rates were negative. Now they're not. We've got the rise in yields, but against this backdrop of a large debt burden. And it means that I think governments are going to have to start undertaking some fiscal consolidation to show some credible paths to that over the next couple of years. Otherwise, things will start to get ugly in bond markets. So, yes, to answer your question, to the extent they reflect the kind of return to a bit of normality and certainly to full employment and the retreat of deflation risks in economies, then is not a bad thing. It's a good thing. But it's coming against the backdrop of this high debt burden, and that's the concern.
Jonas, we've had a few questions about, just if you would just decompose, if you like, the rise in yields. How much is, someone's asking, are inflation expectations playing any role here? Lots of questions about this idea of the term premium and how much that accounts for the rise in yields? And then as a follow-on, obviously, where do we see the term premium going from here?
Yeah, that's a good question. And I guess there's two different ways of splitting long-term bond yields. But if you look at inflation compensation, whether swaps or inflation-linked bonds, that's not really the main driver. It's up a little bit over the past few weeks, but it's not the main part. Mainly, it's real yields or the non-inflation part of the inflation-linked bond that is going up by more. So that explains the bulk of the move. And I think that is something that we and certainly policymakers will take some comfort from, because it suggests that it's not conclusive proof, but it suggests that credibility of the inflation targets that the Fed and other central banks have set at 2% is broadly still intact. That longer term inflation compensation is a bit above 2%, but roughly in line with where it has been historically. So that's not what's blowing out. It's the real yield that's blowing out, and that points to if you think about it, the other way of splitting long-term yields into risk neutral inflation interest rate expectations, and then a term premium on top of that to account for the residual factors, demand, supply balance, and so on. And on those estimates, the most timely one we get is the ACM one from it's the Fed's measure, but it's not an official Fed measure, that has been creeping up over recent weeks. And then that's one way of looking at it. You should always take term premium estimates with a pinch of salt, but it's consistent with everything else that we've seen in the bond market. The curve is steepening, and to the extent there has been news, it's things that will make you more uncertain about the future of interest rates in the US. And it also goes to the point that Neil was talking about, that this is ultimately a fiscal problem more than anything else. So that's how we see it. Term premium are creeping higher, and that makes sense. It's with the economic backdrop that we have, both fiscal policy being unsustainable quite clearly now in the US, and also the economy is running pretty hot. In the US more so than elsewhere, and that's an environment in which you would expect longer term yields to be a bit higher and term premium to be on the up. If you take the ACM estimate, and most other estimates are sort of in the same ballpark, it's somewhere like 80 or 90 basis points at the 10-year point now. That's up from negative 50 or 100 basis points at the peak of the pandemic, and then the years ahead of that. So that's quite a big swing, certainly over the past few years. But in terms of the level, again, we're basically back to where in the mid 2000s, mid 90s, that period. In fact, we're a bit lower than the average of, say, if you take 95 to 08 as the analogy. There's still another 20, 30 basis points to go to get to that level. And I think that's a reasonable best guess for where we end up. Now, on top of that, I think you have to worry about term premium blowing out sort of short episodes like we've seen that. Obviously, we saw that here in the UK a few years ago, 2022. That kind of episode where the term premium just explodes, that is what you get really worried about, because that leads to broader dislocations and spillovers and so on. And, the risk of that kind of episode is clearly increasing, although I don't think we're quite there yet in the US.
I know there's lots of questions, David, about kind of what policymakers are going to do about this, so I don't want to hog any more time. But I think just to go back to a previous question that we had about kind of what's driving all of this, and the point I made was that at times when you get these big moves in markets, everyone has a theory, and so you end up with kind of 5, 6, 7 different theories of what's going on. I think one of the things that we can rule out, actually, in terms of a driver for the sell-off, I think it's to what Jonas was just saying, is that this is about inflation concerns. Some people have said, as the war in Iran, higher energy prices, concerns about Warsh and whether just how committed the Warsh Fed's going to be to a 2% inflation target. I think this sell-off was due to those inflation concerns, that we'd see it more clearly in inflation expectations. We're not seeing that. It's coming through instead in real yields and in term premium. So yeah, it doesn't necessarily answer the question as to exactly what's driving it, but I think we can rule one thing out, which is that it's all about kind of inflation concerns.
Neil, let me ask you, lots of questions coming in about this Treasury intervention. What can governments do to manage or mitigate the risks, the costs that come with higher yields? I don't know if you want to call it financial repression, but just using the Scott Bessent's intervention, this increase in buybacks as an example, is that the kind of thing we can expect going forward? Is it effective? What's your take?
I would turn that a bit more and put that in the kind of debt management camp rather than kind of financial repression or anything more fundamental. No, I think there are basically three buckets of things governments can do. And I think it is governments, by the way. I think central banks, obviously, they can backstop the sovereign bond market if things get if you start to get some really severe dislocation and risk to financial stability. But by and large, central banks are going to step away from this and not really view it as their problem to deal with, I suspect. So it's a fiscal problem, as I say. It's therefore up to governments to really to address. And there's three ways they can do it. There's through what I would kind of term debt management techniques. So there's the Treasury buybacks program that Secretary Bessent has used over the last 48 hours. You can start issuing more at the short end, less at the long end if you're getting pressure at the long end of the curve, those kind of measures. There's financial repression. So you could just lean on commercial banks to hold more sovereign debt, particularly long maturities if you wanted to. You could cap yields. I mean, that's what we have with Regulation Q in the 1950s. Much more difficult to do in an era of liberalized capital flows and open capital accounts. But that's really stringent form of financial repression. But I think really that none of that is any substitute for getting to grips with the really fundamental issue, which is the third issue, which is fiscal consolidation. That's what they've got to do. Now, that's not to say that they need to come out today with a plan to tighten fiscal policy tomorrow. But there has to be some acknowledgement, particularly in the US, where neither party wants to acknowledge the fact that there's a federal budget deficit of 6% of GDP at a time when the economies of unemployment, and come up with a plan for what we're going to do about this. What is the pathway for bringing debt and deficits down? So you've got these three tools. You've got debt management tools, you've got financial repression type tools, and you've got fiscal consolidation. That's what they can do about it. What are they going to do about it? Pretty skeptical if they're going to do anything in the third camp, frankly, at this stage, unless they're absolutely pushed. So we're into the kind of camps 1 and 2. The moment it's mainly about debt management. That seems to be helping a little bit at the margin. I think we wrote a piece, and again, we can link to this and send it out afterwards about financial repression and how that's going to make it come back, but how it also exists on a spectrum of very different policies. I think that may not be too far behind either.
Jonas, very immediately, you said this. Described this as a reprieve at the beginning, the move down in yields, now they're creeping up again. Are we going to expect more announcements from the Treasury, or where does Bessent's interventionism go next if this continues?
Well, that's a good question. He certainly has a habit of pulling various rabbits out of the hat, so I wouldn't exclude him doing something similar in the coming weeks. He could do more of this kind of debt management buyback stuff, but in some sense that's really just a sticking plaster, rearranging the debt buckets a little bit. They just had the quarterly refunding announcement where they announced plans for what debt to issue over the next quarter, but they could conceivably revisit that, or more plausibly when November comes around and the next QRA is due, that they just shift the balance further towards the short end. That's something that the EU has been doing for a while. Japan has done it. The UK has done it as well. Although in those cases, they're starting from a position where there's a lot more long-term debt in the system than is the case in the US. So the US has less space on that particular front. But you can see him doing that. Or he could do something unorthodox, something unconventional. I don't really know what, but maybe some sort of trying to get private investors to commit to buy a certain amount of long-term treasuries, or maybe foreigners to commit to holding on to the ones that they have. Something weird and wonderful along those lines. He certainly is fairly innovative as Treasury Secretaries go. He's not afraid of trying new things, for better or worse. So I'm excited to see what he has in mind next.
That was Jonas Goltermann and Neil Shearing on the global bond market sell-off, its causes and its consequences. You can watch the whole briefing on our website, capitaleconomics.com, where you can also find our bond forecasts and analysis, including that note on financial repression that Neil mentioned. Before I go, a small correction to last week's recording. I said our UK team is estimating that this October's budget will raise something in the order of £25 billion in taxes. I meant to say that was comparable to 2025's budget, not to Rachel Reeves' giant 2024 tax grab. To clarify all this, I'm going to relink to the note from Ruth Gregory, our Deputy Chief UK Economist, in the podcast notes. But that's it for this week. We will be back next week with more from the world of macro and markets. Until then, goodbye.